This is John Martinka, and my special guest today is ESOP expert Kelly Finnell. Uh, and this is the Getting the Deal Done podcast. And today we're going to talk about getting the deal done with an ESOP, who it's for, when it works, who it's not for. Welcome, Kelly.
Thank you very much, John. It's great to be with you.
You are an ESOP expert, so let's start with two things. How did you get to where you are now dealing with ESOPs? And then give the audience the basics of what is an ESOP, because there are a lot of misconceptions out there. I run into them, every month, I would say.
Well, I got into this business totally by accident. I had just finished my first year of law school in 1979, and I had the opportunity to work for this big firm in Massachusetts. I went up there for the summer, and I was with a group of pension lawyers. And each Monday morning, we would have a meeting, and the manager of the department would assign tasks for the week. And so on this one particular week, he had gotten a letter. This is long before email in 1979. And the letter was from one of their clients in New Orleans asking for a white paper on ESOPs. Well, ESOPs had just come into the law 5 years before this with ERISA in 1974. And so all of these experienced pension lawyers sitting in the room looked around at each other, and each of them said, I don't know anything about ESOPs. And so the manager said, well, we'll give this job to the kid. And in 1979, I was the kid. And so I spent that summer researching and writing about ESOPs, loved the concept, went back to law school, graduated in 81, finished up the bar exam that summer, and started my company in the fall of 1981. So for the first 25 years we were in business, we did a full array of retirement plans, defined benefit plans, 401k plans, and we would do a few ESOPs each year. Then, about 17 years ago, I had become very bored with the other aspects of the business. I wasn't ready to retire yet. And so I sold the non ESOP part of our practice to my partner. He had been with me that entire time. He was a CPA and a certified pension consultant. He is still operating that business successfully today. And so for the last 17 years, all we've done are ESOPs, and we do that work from coast to coast. We do 8 to 12 transactions a year, and it's just been a great business. I love being able to help business owners cash in on their life's work while at the same time taking care of their employees, the people who help them get to the point where they could do this.
Great.
In terms of what is an ESOP, it's really two things in one. For a business owner, it is a liquidity strategy and an alternative to selling to private equity or to a strategic buyer. It is a way for a business owner to sell to their employees using a qualified retirement plan, which at its core is what an ESOP is, as the vehicle for structuring that sale to the employees. And so it's really those two things, a liquidity strategy for the business owner and a retirement plan for the employees.
Okay.
And the way all of that works is that a business owner establishes an ESOP, hires a trustee, sells their stock to the trustee who's representing the interest of the employees. And then over time, the company makes contributions to the ESOP, which it uses to pay off the debt that was used to buy the stock. And that debt usually comes from a combination of a bank loan and a seller debt, a seller note from the selling shareholder.
Okay. So let's back up a little bit. What does the acronym ESOP stand for?
employee stock ownership plan. I run into a lot of people, even some of my clients that we've worked with for years, still call it an employee stock option plan. With option plans, employees have to spend some of their own money to purchase the
Right.
stock that they receive. So this is a difference with a distinction with an ESOP, an employee stock ownership plan. The company finances the acquisition of all of the stock that goes into the employees' accounts. Employees aren't out a penny as part of this plan.
Now, it can be, I know this from experience, having been on the board of an ESOP company, it can be 100% owned by the ESOP. Is there a minimum amount the ESOP has to own?
Nope, it can be a fraction of 1%. But as you suggested, John, today, about 80% of the new ESOPs that are established are 100% ESOP owned.
Now, there are some tax advantages to both the, uh, the seller and the lender, right?
Well, the seller and the company. So, from the company's perspective, if a company is 100% ESOP owned, then that company is going to operate tax free as long as it remains 100% ESOP owned. And so, when I tell business owners that, they say that can't be true, but it is. It's not a loophole. It's not something that the IRS or Congress are unaware of. It's been a provision in the Internal Revenue Code for more than 25 years now. And some of the largest companies in the country are taking advantage of this. Public Supermarkets is the largest ESOP owned company in the country. They've got over 300,000 participants and beneficiaries in their plan, and they compete very well with Kroger because their employees are super motivated. You get much better service at Publix because they're so motivated, because they own a piece of the company. And Publix has a big pricing advantage because they don't pay income tax where Kroger does.
I get that. We have a friend out on the West Coast, Winco is an ESOP,
Yes.
and we have had a good friend, and he was a Boeing engineer, so he's the main breadwinner, and his wife worked at Winco, and it was I was amazed when she said how much when she re took an early retirement, how much her ESOP was worth
Yeah. It
for
is
being an
more
account
than
bookkeeper type.
Yeah, it can be more than a retirement plan for our employees. It can be a wealth creation vehicle. Most employees receive much larger benefits from their ESOP account than they do from their 401k.
Yeah. Now, don't banks have some tax advantages too when they lend to an ESOP?
They used to, John, but that was a long time ago, and that benefit lasted for a very brief period of
Okay.
time. But you're right, at one time, a bank could exclude 50% of the interest that it earned on a loan that it made to an ESOP, but that's been gone for a while now.
Okay. All right. So you mentioned the company sells the stock to the trustee, and when we talked a couple of weeks ago, I mentioned this when I was on the board of an ESOP, and we had to make some changes in the C-suite, and some of the employees were like, "Well, how come we weren't consulted? We're owners." And who really owns the company?
The trustee
The
owns
trustee.
the company, but then the question is who manages the company? And so corporate governance in the ESOP works exactly like corporate governance in any other situation. You have a board of directors. That board is elected by the shareholders, and then the board hires and fires and monitors senior leadership.
Right.
And so when senior leadership is not doing the job and need to be replaced, that's a board decision. That is not a trustee decision. The job of the trustee is to elect and monitor directors, and then directors' jobs is to hire and monitor executives.
As I recall, we did make the trustee aware of what was going on.
Yes, that's very important. you'd want your shareholders to know, but you wouldn't need to ask their consent. But it is definitely a best practice to keep them apprised of important company decisions like that.
So, what kind of company is suitable for an ESOP? Any type of business, size of business, all of that.
Well, in terms of type, the only companies that can sponsor an ESOP are corporations. But about half of our clients, every year, clients that we're doing a new ESOP for, about half of them are not a C or an S corp when we first meet them. They might be a partnership, an LLC, and so as part of the pre-transaction planning, they incorporate. They either decide to make an S election after that incorporation, or they're taxed as a C corp. And so, in terms of types, the vast majority of ESOP companies are S corps, but there's still some C corps out there. But you have to be one of those two. In terms of size, you need to have a company that has at least $2 million of adjusted EBITDA and at least 35 employees. Now, those are rules of thumb. Are there exceptions to those rules? Absolutely. But if you use that as the benchmark, you won't go too far wrong.
Okay. But industry type doesn't matter. Manufacturing, distribution, service, retail,
Yeah,
professional services?
it depends. But originally, going back 40 years ago, the vast majority of companies that sponsored ESOPs were C Corps in the manufacturing industry. And so there was a lot of ESOP activity in the Midwest where there were older manufacturing companies and the owners were looking for liquidity strategies. Manufacturing companies own property, plant, and equipment, so that was easy for a bank to finance that transaction because that's the type of
Yeah.
collateral that they want. Now, most of our clients, and I think this is pretty well true throughout the ESOP community, are service organizations. One of our biggest industry niches is engineering firms.
Mhm.
We've done well over a dozen transactions for engineering firms. We're in the middle of one now for a big engineering firm out west. We also see distribution. We've done half a dozen ESOPs for uh, wholesale distributors of wood flooring products. That's a little niche that we've developed. Architectural firms. But in terms of high level professional service providers like doctors and lawyers, you can't have them directly sell to an ESOP because, as you know, in order to own the stock of a professional practice, you have to be a member, a licensed member of that profession. And ESOP trustees and their employees are not typically licensed
Okay.
member of the profession. You might have a medical practice with 100 people, and 10 of them are licensed physicians, and the other ones are staff. But there is a strategy where those two businesses are separated, where the medical practice is separated from the support functions, and companies often do ESOPs not for the medical piece of that business, but for the management piece of it.
Okay. What are, it's a fascinating subject, and I know it works very well for the right situation. Uh, and and I also know that the ESOP has and the company has to be very aware not to get over leveraged. I've seen that. I have a friend who did a turnaround of an engineering firm that was an ESOP because it was an old ESOP, and it was they sold it for the founders got way too much money and there was way too much debt, and it took them a long time to recover. So, what are other
Absolutely.
things people have to watch out for?
Well, you need to have a strong successor management team. And perhaps that was part of the problem with that company. An ESOP is a form of internal transition. And so whenever you do an internal transition, whether it's an MBO or an ESOP, the key to the success of that organization is going to be the skill of the successor management team. I often say that the best company for an ESOP is the company where the boss comes in late, takes a long lunch, and leaves early because he has to have in place a strong successor management team that's running the company while he's out playing golf. And so that's really a critical consideration. The other one you mentioned, don't get over leveraged. Companies typically, if they have $10 million of EBITDA or less, are able to borrow up to 2 times that EBITDA without any personal guarantee to finance an ESOP transaction. But that doesn't mean because you can do it that you should do it. So many of our clients say, we're going to go at this cautiously. And on this first tranche of debt, we're going to borrow half of what we could. We're going to see how that works. And then maybe a few years from now, we go full bore because we've got this under control. And then we borrow 2 times and use a portion of that to pay off the seller notes.
Yeah, I was just going to say that the other part is the seller note, and then you refinance to the seller notes with the bank.
Yes. And so that's structure, you can tell your experience in this, that structure is what we almost always see. So the bank debt almost always has a term of 5 years, might have a slightly longer amortization. And because the company's operating on a tax-free basis, often that 5-year note's paid off in 3.5 or 4 years. So let's assume it's 4 years. Now the company has the option of either paying the seller note on the original schedule, or more likely, what the company will do is go to the bank and say, look, this works so well, let's do it again. And they borrow a second tranche of bank debt and use that to prepay all or a portion of the seller note.
Yeah. Okay. Uh, yeah, this is it's very interesting, and I know it work as I said before, it works really well for the right situation. Uh, what kind of mistakes have you seen people make? Obviously, not ones when you were advising them.
We have not um, seen many mistakes, but there have been two big ones in my 45 years experience. One was a situation where the company did not have a successor management team. I mentioned that companies need to have a
Yeah.
strong successor management team. This company didn't even have a weak successor management team. So this was done years ago by a different firm that we then ended up inheriting a consulting role with the company. And that company survived maybe 3 or 4 years after the ESOP was done because the owner took the money and ran. I mean, he literally took his proceeds from the ESOP sale, uh, bought a boat, married a young woman, and moved to Florida. The classic scenario. And so that's one where things didn't work. Then the other issue that we've seen is where companies over leverage. And uh, that really came to bear in 2009 and 2010 after the Great Recession. So many companies, many ESOP companies, and other non-ESOP companies too, at that point were in violation of their bank loan covenants because business had dropped so dramatically. And so in those situations, the bank's almost always willing to work with the company to grant temporary covenant relief. In that situation, the selling shareholders often defer the interest on their seller note until the company's financials get right again. They haven't given up any of the interest on their seller note, they just deferred it. And all of our clients during that 2008 and 9 period contracted and had to do some things like that, but they came out the other side stronger than they were before.
What are some of the uh, valuation nuances for ESOPs versus non-ESOP firms?
Yeah, that's a good question. The first thing that it's really important for business owners to know, and most of them come into this with a false impression. The company does not hire the valuation firm. It is critical, and the law requires that the valuation advisor be independent of the company. So the first step is the company hires the trustee, and then the trustee hires the valuation advisor. The company gets the privilege of paying the valuation
Yes.
advisor's fees, but uh, you have to have that independent arm's length relationship between the sellers in the transaction and the purchaser, which is the trustee. So it's really important that the uh, valuation advisor satisfy the ERISA definition of independence. And then you also need to have uh, a valuation firm that has ESOP expertise. ESOP valuations are different from an estate and gift tax valuation or from the type of valuation that you might see in uh, uh, a dispute, a matrimonial dispute, for
Yeah.
example. And so we have people say, I've got a great CPA firm that does valuation work. They've also done our accounting work. Okay, so they're not independent. And while they've done hundreds of estate and gift tax valuations, they've never done an ESOP valuation. And so you just want to make sure that the firm's independent and that it's a firm that has lots of ESOP experience.
Yeah, one of the other board members, he came on about a year before I left this board. He came from a pretty large construction company that was an ESOP, and every meeting he would say at least once, "You really see the value of an ESOP when the debt is paid off, and the valuation just takes off."
Absolutely. And so that is the biggest driver of value. I have clients who have come to me and said, Kelly, I got this huge problem. I said, what are you talking about? They said, well, we just got the ESOP debt paid off and we're building up all of this cash within the company, and I don't know how to deploy all of this cash. That's what is called a first world problem,
Definitely.
but it happens all the time.
So, Kelly, tell us a little bit about your firm because you are not an investment bank. And I know there are some specialized investment banks that set up ESOPs. Tell us
Yeah.
about what your firm does for your clients.
We are a consulting firm. And so I grew up in the business world after having graduated from law school. And so I view fees for service based on the amount of work that's involved. And so the time that's involved in a transaction. So our fees are fixed fees that we tell the client in advance. There's total transparency, and our fees bear no relationship to the size of the transaction. And so we're working with the company now that could potentially sell to an ESOP for $1 billion. And a few years ago, we did an ESOP transaction where the company sold for $10 million, and our fees for those two companies are the same. We actually spend less time on the big transaction
Yeah.
because they've got better advisors
Yes.
internally and externally, you know.
I do the same thing. You get naive buyers or sellers, and you get the attorneys are not quite as sophisticated,
Yep,
and you can put in more time on a small deal than on
yep,
certain parts of it.
yep.
Now,
If
when it
you
gets to
don't,
that stage with the attorneys. So, uh, fascinated discussion. What do you like to do when you're not working with ESOPs?
two things, play golf, which I've been doing for a long time, and spend time with my grandchildren, which I've been doing for the last 13 years. We've got two daughters, seven grandchildren, ages 7 to 13. And so my wife and I just love spending time with them. We're taking four of them to dinner tonight.
Cool. Really nice. Is there anything I should have asked you about ESOPs that you'd like to get out before we end this conversation?
Just one thing, and that is for business owners to know that an ESOP process begins with them hiring a firm like us to do a feasibility study. And in that feasibility study, we're going to answer the four key questions that every business owner has before they're able to make a decision about whether or not an ESOP is the appropriate strategy. The first question is valuation. If I sell to an ESOP, what can I expect the sales price to be? So an ESOP specific estimate of value that we do. The second is financing. We talked about bank debt and seller debt. They're going to want to know how much cash they're going to get at close and what the terms of the seller debt is going to look like. The third question has to do with corporate governance, what we talked about a few minutes ago. And then finally, our clients tell us that while all of their employees are important and they want to reward all of them through the ESOP, some of their employees are critical to the company's success. They want to do something extra for them. And so the fourth thing that we address in the feasibility study is stock appreciation rights for the company's senior leadership team.
And warrants also?
Warrants for the selling shareholders.
Yes.
Yes, that's right.
Right.
And so
Okay.
that's part of the discussion in the feasibility study that deals with financing because the warrants are a piece of the return on the seller net.
Right. So to wrap up, this is Kelly Finnell, and he is the ESOP expert. I like the fact you're not an investment bank, that yeah, do they do things a little bit differently. And as a consultant, again, from my own experience, that all the things you mentioned, I saw, good, both the good and the bad. And again, it can be a great thing. So, Kelly, thank you so much for being on the Getting the Deal Done podcast. And I wish you well as you set up all these ESOPs.
Don, thank you very much. I really enjoyed the conversation.